I've been told from you and other people that if I love the concept of infinite banking, this is infinite banking on steroids that the government's giving a deduction on.
Cash balance plans fall under Section 401A.
Okay, let's break that down.
As your income and age goes up, you can deduct anywhere from the same amount as a 401k to 22 times the size. This is where it gets really cool. In a 401A, you can buy cash, you can buy stocks, and you can buy bonds. However, two other assets can be acquired with pre-tax dollars. One is life insurance, and the other is annuities.
Can you put all your money in a DB plan into life insurance? What's the limit there?
This is very interesting. It depends on
how do you structure life insurance when you're trying to get the best long-term, but you're also trying to maximize the buyout period as well?
Phenomenal question. And it's going to start with a sad answer that's going to break your heart.
Oh, no.
And then we're going to be happy again at the end. In a defined benefit 401A world cannot use a POA rider.
Are you serious?
Now I'm going to make you happy again, okay? There are both carriers and design elements out there that you can still have a policy break even in year 4 or 5 without a POA rider.
Really?
Now you got it.
I actually feel like the market for this conversation is 100 times bigger than the infinite banking market. You're creating a wrapper, and that wrapper allows you to actually deduct the premiums that they're putting in, and you can get 6-figure deductions.
On the low end. So let's put numbers to this. We finished a case recently for a 68-year-old husband and wife, and we get roughly a $600,000 deduction.
If I'm buying life insurance with my DB plan, what year should I exit that?
Such an interesting question, and my answer is...
My goal in this conversation is to leave understanding how DB plans work. I've seen many people talk about it. I've seen people from the home office talk about, this is like the best thing in the world. And I get some parts of it. I get the whole okay, deductions are great and all these things. But I never walked away being like, this is like the silver bullet where it's like, this is where I want to talk to so many people. So that is a challenge. I know that there's a lot of people listening. There's going to be people watching. The goal is to have like a master class on how DB plans work. When do they fit for people? When do they not fit for people? And I can't think of a better person than you, man. Welcome to the show.
That's exciting. Thanks for having me on. And I hope I can live up to that expectation. And I think what I'm looking for from you is ask the question you think the audience and the business owner has top of mind, because what ends up happening as soon as you start talking DBs and tax, you hear jargon, people need to relate to the material. And so I think my team, Mark and I at the Owner's Asset, do a really good job of breaking it down in English. So I hope that comes out today as we talk.
We got connected when we were in Puerto Rico. We played some golf, had a lot of fun, and I walked away. And you actually have a free gift that you'll give to everybody. We'll get your book as a giveaway. Hopefully that's okay.
Absolutely. Yeah. Okay. It's a playbook. Book makes it seem like this.
Okay, a playbook.
This treatise on it, but it's designed. Interestingly enough, what we found as we started talking to small business owners is that the headwind they face is as you become successful, as your business grows and your practice grows, you're spending the marginal dollar on taxes instead of growth. And we approach business owners with our solutions, with our opportunity to collaborate, and we found that CPAs didn't have as much background. So the playbook we authored is designed to those audiences with a little bit more emphasis on the CPA, interestingly enough. Okay. So that would be a great leave behind for folks who find this topic interesting.
Cool. All right, so I'm going to tell you what I know, and then we can dissect it. We can you can take this where you want to take this. So obviously, the people that are watching this, a lot of them know that we're big fans of life insurance. We talk a lot about structuring policies properly. When set up and used properly, you don't get a tax deduction for typical life insurance. But once your money's in, it can grow tax deferred. You can use it tax advantage. It gets passed on income tax free, very safe. There's creditor protection in every state. Some states 100% creditor protection. And when you start looking at like the IRR of a policy, and then you start factoring in death benefit and other benefits, you're seeing that this asset is amazing. Especially, it's not an investment, but it's a place that can give your dollars more jobs. And we believe that if the person that can give their dollars more jobs wins in the end, and it's a great asset to play along with other assets. Okay, so that's bringing people up to speed there.
Yeah.
Now the disadvantage, anytime I say like disadvantages of insurance, is you have to qualify health-wise. So not everyone can qualify. It takes a few years to have more money than what you put in. Some longer than others, but if you care about immediate liquidity, insurance is not the play for you. And then the third aspect is you don't get a tax deduction for funding a life insurance policy. Now, when I think of a DB plan, I think of taking a life insurance policy that's maybe engineered slightly different. You can dive into that. Slightly different, maybe a little bit less max funded. And again, you can correct me on that. But what you're doing is you're creating a wrapper, And that wrapper allows you the business owner to actually deduct the premiums that they're putting in, and I mean, these premiums can be large. You can get six-figure deductions,
On the low end.
and you put money into a DB plan, and you get all the benefits of insurance, and then the goal is to buy that out of the plan, and that's where it gets a little foggy for me, and again, we have our team, I have I'm the dumbest person on the team, okay? So, I'm not but so you buy it out, and there's some type of you obviously get the deduction, and then there's something on the buyout where I don't fully get is I feel like it's just a straight up deferral, and during the time of deferring, I feel like you lose a lot of control, but I've been told from you and other people that if I love the concept of infinite banking, this is infinite banking on steroids that the government's giving a deduction on. So I wanted to set the
It's a lot.
stage. I wanted to set the stage of like, I'm here to learn. I'm excited, and I don't know, grade me on my overview, but I wanted to just kind of set the table.
That overview is outstanding and dense. There was a lot there. I wanna start where you started with, I'm a convert to the life insurance industry from money management and wealth management. Prior to doing this, I served as chief investment officer of one of the largest community banks in the country, where I oversaw a $4 billion book of business. I fell in love with insurance from a reverse process of some of my most affluent clients were like, "You need to understand this. Check this out." And then I fell in love. So that's where my love affair with life insurance began. And your comments of, look, guaranteed growth. I use the phrase cap, right? It's controlled, it's asymmetric, and it's productive. It's asymmetric because it never goes down. You talk about control and intentionality a lot on this show, right? The community you're building here is outstanding to really an outstanding audience to understand the benefits of life insurance. So you talked about liquidity, IRR, right? Permanent liquidity engine. All of that is there. What do we do with the owner's asset? For people who either don't know they love life insurance yet or do, we have a way to help you buy it wholesale, not retail. So you talked about the tax arbitrage. I'm going to skip that for now because I think the very first comment was, help me understand what a DB is. Do you want
Mhm.
to start there?
Yes.
Where I've found, I think, some success in explaining it to people is comparing it and contrasting it to a 401k. I think America's love affair with the 401k has given people a good foundation to understand qualified assets
Mhm.
and their pros and cons. So let's do that. Let's start at comparing them and please jump in with questions because when I get going like you, we're both passionate about this. We're going to be firing back and forth. Cash balance plans fall under section 401a. And that's the last time I'm going to use jargon. But the reason I'm doing it is because we're already creating a bridge between the two 401, 401, A and K. It's the same section of the tax code. If you understand a 401k, you actually understand 96% of a 401a. So let's start with what you know. We talked already about eliminating the barriers to understanding and to learning. Let's compare it to something people understand. The money you put into a 401k, is it pre tax? Yes, you get a deduction for doing it. Same with the 401a. When a 401k closes, it can roll to an IRA. Same with a 401a. So now you understand the in and the out. Let's talk about building it. This is where it gets really cool. So I said it's 96% the same. Let's focus on those 4 points of differentiation to get us to 100% understanding. The first is my favorite. The first is that the 401k is, for lack of a better phrase, inherently regressive. Okay, what does that mean? Whether you make 100 grand a year or 500 grand a year, you're limited to $23,500 this year. The 401a or the cash balance plan grows with you. As your income and age goes up, you can deduct anywhere from the same amount as a 401k to 22 times the size.
Whoa.
Right, yeah, eyeball popping moment. We finished a case recently for a 70, at the time, 70 years old and 68-year-old husband and wife, and we got them roughly a $600,000 deduction. That's life-changing. That's a big impact on it. So the first difference, the 96 to 97, is the sheer size. The volume that you can throw into a 401a is radically different than a 401k. I know we have advisors who listen to your podcast because of this. So yes, there's catch-up provisions of the 60 to 61 and then thereafter. But generally speaking, we're gonna kind of go to the norms. The second, so that's the first major difference. Any questions there?
No, you can put a lot more.
Yeah, it scales with you. It grows as your income and age grows. So really important for an entrepreneur, by the way. In our core business, we focus on small business owners. That's where this solution works for best, right? So the next major difference between a 401(a) and a 401(k) is the types of assets you can buy. This is where I think it gets really interesting. So a typical 401(k), you get a lineup of stocks, bonds, cash, and it's a 40 Act funds typically. The recent legislation, they're trying to get some alternatives into there, so we'll see how that movie plays out. But in a 401(a), you have access to all those same opportunities. You can buy cash, you can buy stocks, and you can buy bonds. However, 2 other assets can be acquired with pre-tax dollars. One is life insurance, and the other is annuities.
Mm.
That's where it gets really interesting. There are only a handful of ways, and I'm becoming a tax nerd, but I'm not quite there yet. But, roughly 4,300 lines of sections of the tax code. There's 2 or 3 ways to acquire life insurance with pre-tax dollars, and this is one of them. So that's the next major difference. It's super interesting, and we can flesh these out as you guide me to where you think you want to go, Caleb. The third major difference, and this is actually a bit of a con, because I love when you were introducing your love with life insurance as, look, there's some degradation in liquidity in the early years. There's a con to everything. Everything has a pro
Yep.
and a con. In this case, there is an IRS commitment to the 401(a), sorry, to the cash balance plan, to the 401(a) system. Guidance is 5 years.
Mhm.
Minimum statutory requirement is 3 years. So what does that mean?
Need to fund for at least 3 years.
Exactly. You're having a tough year, you cannot contribute to your 401(k), and there's no sort of implications to that. When you make the decision to build really a private pension, because it's a defined benefit plan, it's technically called a hybrid plan because it has characteristics of both. But when you make the decision as a business owner or a solopreneur, this works great for 1099 income, by the way. So side hustles, you can deduct your side hustle back out. I mean, just don't have to think of it as a formal rigid system. But the part that is there is some rigidity is the commitment. You can't make an annual on-off decision like you
Mhm.
can with an IRA or a 401(k). So you asked, kind of alluded to it, who does this work for? Your business has to be relatively stable. You can't have highly episodic revenue because the commitment levels are not only temporal in that they're 3 to 5 years, but they're relatively consistent. That was the second difference or third difference, right?
Yeah, so I have you can hire deductions, you can buy life insurance and annuities, and there you do need to commit for at least 3 years. The target is 5 years.
And then the fourth difference, so now we're at the 99, we're going to the 100, you alluded to elegantly, was there's what I like to phrase is there's a nice exit opportunity inside of a cash balance plan. So your 401(k), let's go back to what we know, let's go back to what we understand. In your 401(k), that money's locked up until 59 and a half at the earliest, where you pay a penalty. And then if you have been successful from a financial perspective, you generally let it compound until 72, 72 and a half now, right? Life insurance occupies a very interesting part of the tax code in that you can actually, to your point, you said buy it out. That's correct, by the way. The technical definition would be to distribute it out.
Mhm.
So I don't believe you pay the penalties on it, but more interestingly enough, you pay it on the cash value, not the death benefit. So you can get $200,000 of cash value for less than that amount.
That's right.
So the first source of arbitrage is the tax deduction on the way in. The second source of arbitrage is that you can pull it out for quarters on the dollar. Pennies on the dollar would be misleading, right?
Yeah.
But you pay a little less than the amount that you've put in to pull it out. And then the third source of tax arbitrage is we're entering your world. It's life insurance. It grows tax free. You lever it tax free.
Yeah,
The death benefits tax free. So really interesting. And you could do that at any point during the cash balance plan process.
but in life insurance, you're almost incentivized to do it as soon as possible because the cash value is only gonna get more attractive as the plan goes on.
Extremely well said because you talked about that. I'm going to use the word gestation period, right? That it's
I didn't use
underwater.
that word. I don't
Did,
know.
right? That those first few years where the amount of cash value is below
Yes.
the premium paid, right? Well, imagine getting to overcome that hurdle of life insurance on a tax-free basis, on a tax-deductible basis. So let's put numbers to this. Let's put some meat on this. So I'm probably like like one of the South Asians who's not amazing at math. So we're going to use round numbers. Okay, we're just going to do that
I
to,
love this. I
to
love
play into
this. Yeah.
stereotypes a little bit here. If an individual's working with you in your organization, Caleb, and you've determined that to meet their financial goals, because I know you have their financial goals, you have the X-ray process and a lot of things that you do, they're going to need to pay approximately $100,000 of premium, right?
Mhm.
Let's assume they're in the highest tax bracket. That's roughly $140,000 of earnings needed to
Yes.
spend $100,000 on life insurance. Okay, this is back to that first source of arbitrage. If you're getting a deduction to buy that $100,000 worth of life insurance, you're only shelling out 62,500. That's at
That's right.
37%. Whoa. Do I want to earn 140 to buy $100,000 worth of life insurance? Do I want to spend $62,000 to buy the same amount of life insurance?
That's right.
Now, in both cases, right, ceteris paribus, you're going to be a little underwater on the cash value. Well, if you're paying that little for it, it's a little bit less of a hit, right? Your second point was much more interesting is control. Unequivocally, and I want to be clear here for the listeners, you cannot use the loan features of life insurance when it's inside
In the
of the
DB
DB
plan.
plan. So it really is just saying, okay, I'm getting a tax deduction for protection. I'm getting a tax deduction for liquidity. I'm getting a tax deduction to gestate my infinite banking system when it comes out.
Yeah.
Super cool. Super cool way to do it.
So let me just run some numbers. Normally, are you trying to get the plan out in 3 years or 5 years? Like, what's the ideal in an ideal scenario? What's the if I'm buying life insurance with my DB plan? What year should I exit that?
So such an interesting question. And my answer is, I think, really fun. There's no correct answer because each situation is very different. And
Okay.
so we're our organization, we've put in place enough of these plans to run the whole spectrum. So let's walk through the bookends to give listeners the two diametrically opposed parts of the scale here. One of the cases we did was a very affluent couple who had no life insurance and finally was getting to the point where they wanted to do their estate planning. So why not give them a tax deduction to do their estate planning? Well, this just got really elegant, right? So in that case, you're going to use a design and a product because there's a lot of latitude in designing cash balance plans. By the way, it's not necessarily completely turnkey. The administrative and the servicing we make turnkey for you, but the actual design requires a really a well educated agent like Mark or myself to work on this. You would pick a different life insurance chassis for estate planning and for someone older than, say, a very successful 45. Now, this is the other bookend, a younger entrepreneur. You can keep the plan alive for longer and distribute the insurance out whenever you want.
Really? Okay.
Yeah.
So you can keep the DB plan,
Right.
but you can you use the I use the word buy it out. You use the word distribute it out. You can distribute the life insurance out while they keep the DB plan in.
Absolutely.
Can you then buy more life insurance?
Absolutely.
Okay.
Provided now this is not like sort of key man insurance,
I
whereas
understand.
where this will count against your human life value. So, we'd have to manage that
Right.
for folks who are super, into look, you get it. Once someone understands life insurance, they want to get their hands on as much as they can get their
Right.
hands on. So yeah, you have a lot of latitude. So I hate to be sort of terse about giving you a strict answer of what's the
No,
best
no,
way.
it depends.
It really does depend
Right.
because you can use this as a way to get a tax deduction to do some of your estate planning.
Right.
And you can use this as a way to gestate infinite banking policies.
Mhm.
And you can use it as a cheap option to just get protection.
Right. Okay, so we'll talk about designs in a second, but I just basic numbers. Let's say I put in $200,000 a year, for 3 years. Okay, so I get a deduction on all 3 years of funding.
600 grand.
Okay. Now let's say the cash value this is what I love about this because we teach life insurance is so much more than the cash value, but it's my understanding that they're only measuring the cash value when you distribute it, or they factor in the death benefit as well?
Both and neither, interestingly enough.
Okay,
The death benefit is not part of the calculation when you distribute it. And it is a good proxy, but ethically, it's not just the cash value because there's a couple other calculations in creating what is the fair market value.
okay.
Now, I hope we have some CPAs and some tax forward advisors listening. It's section 2005-25 of the tax code that helps us value what the cash value comes out as. And to make it even more clear, because I never want to be wishy washy, it's usually a little less than the cash value.
Really?
Because yes, love your face expression, because there's something called a PS-58 charge associated with buying life insurance with pre-tax dollars. Without getting too technical, unless you want me to go there, but you basically pay what would be the equivalent of buying 1 year of term insurance with after-tax dollars to own life insurance in the plan, and that deducts your cost basis. So
Mm,
what you're doing is you actually it's a little bit cheaper than the cash value
this
to
is
get it out.
that's very interesting. Okay,
Super interesting. So you're getting a tax deduction to overcome the initial liquidity hurdle, and then it comes out a little bit cheaper. Here's the best part. I know you wanted to
Yeah.
jump in. I'm sorry because I get really passionate about this last part. And I've talked about this with enough of our clients, our small business owner clients that we work with to say, okay, look, I'm an entrepreneur. Liquidity sometimes can be tight. I may not have, let's use your example, was $600,000. Right? And let's say half of it was in life insurance. So $300,000 of the plan was in life insurance. And the cash value was $100,000. Okay. Not a great example, but I need to do math on tens. Again, I'm going
Yeah.
back to my sort of
Yeah.
my handicap, my quant handicap, given my race and background. Um, the IRS would say that $100,000 of cash value is if you earned $100,000. So
Mhm.
you'll pay 37 plus your state income tax
Mhm.
on it. So let's say it's 40%. You're going to say you owe us $40,000. Well, what's so interesting about that is you can take a loan from the policy you just distributed
Pay
to
that.
to pay the IRS back. That's the next source of arbitrage. So I'm
Wow.
sort of building these layers of
So
tax ar
you're building in, yeah, and everyone that's the people that are watching and listening that have been a part of our community for a while, they see the value of that because, yeah, I love that.
How neat is that?
Yeah, yeah, so finish your thought because I wanna go back a few steps and
Sure,
clarify
yeah, because
something.
there's some stuff about design elements
Mhm,
which I really wanna explore, but I wanna go back to my thought and then pull the thread forward. Tax arbitrage 1 was you could spend $140,000 to buy $100,000, or you can spend 62, right?
mhm,
This is the second source of arbitrage is when you pull it out, you're paying a little bit less than the cash value. Another source of arbitrage is you're gestating this policy on Uncle Sam's dime.
that's right.
And then now when the policy comes out, you're guaranteed to have cash value because you weren't allowed to loan against it when it was in the plan. You can use that cash value to pay the IRS back for what you owe. And as you and I know, when you lever a life insurance policy, it doesn't slow the growth rate. Typically doesn't change the dividends, right? There's some talk there in our space about that. And all the growth thereafter is tax free. And that's the final source of tax arbitrage is you've got it out of the RMD system. You've got the money out of the qualified system, right? Where they're going to take 40% every year ad infinitum. You got a big chunk of it out.
Yeah.
You're not paying taxes on it ever again. It is such an I've listened to enough of your work. You talk about intentionality, you talk about flywheels, and you talk about this idea of 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 banking on yourself, this you first mentality. Well, this is a great way to live that because I'm not necessarily anti-tax because if a small business owner is going to grow their balance sheet, they're probably going to hire more people and be productive and give back. Every dollar a business owner is not paying Uncle Sam, they're redirecting that to something productive. You use the word architecture a lot. I feel the same way. This is that kind of an architecture.
Can you put all your money in a DB plan into life insurance? Because you mentioned before that there's a mix.
Yeah.
What's the limit there?
Great question. And remind me as well to come back to overfunding and policy
Okay.
design.
Yeah, I
I
still have another question on just deduction,
I
but
want them all.
yeah.
Just fire them away. There are statutory limits to how much life insurance can be in a defined benefit plan.
Okay.
So it cannot be 100%.
What's the upper limit?
So it typically ranges, and this is very interesting. It depends on the TPA. So let's go back to our 401k analogy. Whenever I use jargon, be like related to the 401k world, right? Your 401k has a TPA, a third party administrator, right? So do cash balance plans. Typically, a TPA limits, and it's per IRS statutes, 40% of the DB plan to be in
Okay.
life insurance. Now, some can be lower, and it's actually, believe it or not, product specific. IULs, that number is lower. And I'm not a
Interesting.
big IUL person. I'm much
Yeah.
more into whole life, but so that's why I can't give it is X number. It
Right.
really depends on the product as
Okay.
well, but the upper limit is around 40% of the DB. So in your $600,000 example that you offered us, right, $240,000 of
Okay.
that can go into life
We're gonna do math. So I hear you. We're gonna do math at 50% just
insurance.
because again, I'm with you on
But I think
the
I got that right,
yeah.
right? The 40% of the 600, I
Yes,
think I
yeah,
got
yeah,
that
yes, but we're just because math is hard, we're gonna say 50% can go into a life insurance policy, meaning in this example, if you put in $200,000 a year, you're getting a deduction, what would that be? If 40%, that would be 80 grand?
Yes,
Okay,
exactly. So while you're doing that, it is a top line deduction because there's a big misunderstanding in the tax world. And I'm relatively new to the tax world, only been really hacking it for 2 or 3 years now, but deduction versus credit. So how this works for your business owner clients, because this will need to also remind me to qualify who can actually do this.
Okay.
'Cause standard W-2 employees actually can't do a 401(a). So we need to put some guidance on that. If your business earned $1,000,000 a year and you did a DB at $200,000 a year, the IRS says, "No, your business didn't make $1,000,000, it made only 800." So it is a top line deduction. I wanna
Okay.
be clear on that, sorry.
Okay. So you put 200,000. I'm gonna stick with this, and then I wanna come back to ask where the other 60% would go hypothetically. But, let's say 50% of it went into life insurance. So you put $100,000 into life and then $100,000 into something else, okay? Now, after 3 years, you've put in $300,000 into life insurance, and we're going to talk about designs in a second, but even if you max fund it, it's probably not broken even. But we're not going to it's my understanding that this actually would be a good argument to where you may not want to be as aggressive with max funding because of what we're talking about. So let's just say there's 150,000 of cash value.
Okay.
Okay. So you put 300,000, you got a deduction on 300,000. You buy it out at 150, let's say it's at 140 because of the math.
Mhm.
So you're paying ordinary income tax on 140, but people that understand life insurance knows that this is just going to get more efficient every single year. This is at a point where every time you fund it, more cash value, it's growing by more than what you put in. And the death benefit most likely is continuing to grow and you have all the benefits of insurance.
Yes,
Right.
nailed it.
That I wanna say thank you for helping me, actually understand,
Well, go one level deeper. So this
yeah,
140, let's call it, you'll pay say your marginal tax bracket's 40%, you'll be paying roughly 57,000, 58,000 in taxes on it. I don't expect you to be sitting on $57,000 of liquidity, particularly as a business owner whose head's down grinding, grinding, grinding. Take a loan from that
right.
140, write your check for 57 to the government. You still have netted 140 minus 57 in cash in your pocket,
That's right.
and you of all people know that cash value is in every way, shape, and form, bold statement coming, right? People should be leaning forward in their seats now, superior to cash.
100%. Yeah,
Cash is taxable, cash value is not.
yeah.
Cash is not creditor protected. All of those things we've already discussed, so I don't wanna go
We
circular.
that's actually who would order a T-shirt that cash value greater than cash?
We should do that.
Let's see if I can get enough people, I'm gonna go make that because you're totally right. 150,000 of cash value. It would be an interesting thought experiment of how much I would be willing to pay. Oh wait, there's a market called life settlements that they do this, but how much you would be willing to pay, and 150 would be the bare minimum, and it would be an interesting thought experiment. What would you be willing to pay to acquire a life insurance policy that's already 3 years in, that's structured properly, a whole life? It would just be an interesting thought.
Sure.
And we're even showing that you're buying this for you're getting a tax deduction. You're using the government's
Now it's
money.
clicking.
Yeah,
Now it's clicking. That's exactly right, Caleb. So I think the question collapses to one simple sort of it's not it's quasi rhetorical in nature, but it's are you willing to spend, in our example, $57,000 for $140,000 of cash value? My savvy clients go, how many times can I do this?
right,
Are you willing to spend $57,000 for $140,000 of cash?
right. Now, and let's go back to, well, maybe let's go to this first, and then I want to talk about where you're putting the rest of the money. How do you structure life insurance policies? Because I've heard that DB plans actually it's they're not supposed to grow a ton. So you actually you have to be careful. I don't know if that's true. Like if you put your money in crypto and you triple, that would actually be problematic with the DB plan. But let's not talk about there. I threw you a curveball. Don't swing at it.
100% accurate
Okay.
statement, and I can answer it with numbers and bring
Okay.
clarity to our audience.
But let's
Go
talk
ahead.
about insurance first. How do you structure life insurance? There's no right or wrong, but I'm curious how you structure it when you're trying to get the best long term, but you're also trying to maximize the buyout period as well.
Phenomenal question. And it's going to start with a sad answer that's going to break your heart.
Oh no.
And then we're going to be happy again at the end. Okay. In a DB setting, in a defined benefit 401(a) world, ready? I feel bad. I know you're going to be sad. You cannot use a POA
Are
rider
you serious?
because it would trigger the incidental benefits provisions of the tax code.
Okay, let's break that down. Break what you just said down.
Basically, it would be anytime you're using tax loopholes or tax strategies The IRS is aware of them because the IRS loves cash balance plans, by the way.
Mhm.
This has been around really since the 1920s, codified in 1979, and then again in 2006 with the Pension Protection Act. They're aware of it, but when you overstuff it, they're saying, "No, no, that's sort of
You're
an
taking an advantage
improper
of.
use of what we're offering you. We're offering you this great deduction. We don't want everybody on a welfare system, right? The IRS, the tax code is an instrument oftentimes of social change, and so and through that lens, overstuffing it triggers certain provisions
Okay.
in the tax code. But now I'm gonna make you happy
Okay.
again, okay?
Okay.
There are both carriers and design elements out there that you can still have a policy be break even in year 4 or 5 without a PUA rider,
Interesting.
whether it's,
Okay.
10 pay, which tends to get
Yes.
right, a shorter chassis, and then there's certain other carriers, and I know we're carrier agnostic generally speaking, but just know that there's ways to have a policy.
Because insurance companies are saying, "We're gonna actually give you a product that is designed to check the IRS boxes for DB plan, but actually get better, way better later."
What's so fun about this is you're answering future questions that you know you're gonna ask me, so I'm gonna try to keep tying it all back together. There's a lot obviously going on, but so just to reiterate, you can't max fund when it's in a CB
Yeah.
plan. However, a good agent is going to know the suite of products that's out there, and I can tell you unequivocally, pending your health rating and age, the standard qualifications in our world, right? You can have a system in place where you will break even by year 4 or 5
Wow.
without a PUA rider. We
Okay.
talked about this briefly at
Yeah.
golf, but, like, so that can be done. So, yes, it's you can't overstuff it, but
But there's a world where a 10 pay could actually be more advantageous, even if it didn't break let's say it broke even in year 6 or 7, because if you're gonna buy it out in year 3 or 4, uh,
that's exactly right. You wanna buy it out. So this goes back to I couldn't give you a straight answer on what's the best design. Someone who is 47, 48, 49, 50, and is really a long-term thinker, they're gonna want a strategy or a product that's not break even for a very long time because the ultimate death benefit on the back end is enormous. Whereas you have someone either later in life or is looking to use this opportunity to create a multiple infinite banking system is gonna want a series of 10 pays. So, unequivocally, there's no right
okay.
answer, but just know that it's not only advantageous because when you buy it out, you're paying on the cash value less some deductions along the way. Yeah, it sort of becomes agnostic. And what's most interesting is this is a really polarizing topic, and I like my inner monologue's like, You're about to step in it, Rowan. Like, this is like weird, but the health rating aspect of insurance is very challenging for the mutuals, right? For someone applying in the world of the mutual life insurance. That becomes a little less relevant when you're using it with pre-tax dollars. So we've had clients who said, "Well, I'm not willing to spend this X dollars, but because they got a slightly lower rating, but they're like,
Okay.
wait a second, I'm getting this enormous deduction. I may be tabled. It's still worth it."
Yeah, I'm with you on that. Who's the beneficiary, if it's in the DB plan? So let's say, yeah, let's go. I'm putting hundreds of thousands of dollars a year into a DB plan. I die. It's the life insurance policy is still in the DB plan. Where does that money go?
Great question. When it's in the DB plan, it is subject to the rules and restrictions of ERISA,
Okay.
the Employment Retirement Income Security Act, right? And so it is generally spousal provisions unless designated otherwise from spousal consent. So it would function a lot like your 401k. Whenever we're talking about DBs, keeps bringing me back to the 401k
Yeah.
world, right? If you have a 401k and something were to happen to you, it tends to go to the spouse, right?
Yep.
Identical once it's in the
Is
plan.
it income tax free, or is there a tax uh, ding if you die while it's in the DB plan?
Yes, but very de minimis, very small when it's in the plan. When it comes out, it's not.
Yes.
It's regular rules. So let's create another case. Let's use yours. Your $200,000 a year is what we were
Yep.
doing in your case, and 100,000 was life insurance. This is perfect. And let's say hypothetically that $100,000 of premium bought you $1 million of death benefit. If something were to happen to you while in the plan,
Mhm.
the $100,000 of premium the IRS would take back and say that portion of the death benefit is taxable. The 900 that's remaining is not.
Okay.
So
Okay.
so still
Okay. Yeah.
hyper efficient.
Yeah. I agree. Okay.
Hyper efficient, but I just wanna make sure everyone understands that that's
Okay.
the
So
case.
it's very similar to a loan because in the IRS is essentially loaning. Like,
Oh, I never thought of it that
yeah,
way.
it's the IRS is giving you a very advantageous loan. Not to say this is anywhere near premium finance, but in a way, you're doing that when you're playing with the IRS because they're giving you they're flirting with you and saying, like, they're giving you an incentive to put money into life insurance. And so that's, I appreciate the answer there. Trying to think if I have any other questions when it comes to the life insurance side. If you buy if and when you buy the life insurance out of the policy, are you telling me that, let's say I'm gonna continue to put $200,000 into a DB plan every year, in year 4, I buy it out. Are you telling me that I can then go into underwriting again, buy, more life insurance?
The short answer is yes, subject to
Why
other
and the IRS is not saying, "Hey, wait a second here, like, I see what you're doing."
'cause it's incumbent just as it is when you buy with after-tax dollars, it's still incumbent on the
They
carrier to assess your human life value.
Okay,
So if
but
you are
you can buy that asset out and start another one.
yes,
'Cause
you
it
have
wouldn't
to
make sense. Am I crazy? It wouldn't make sense to buy it out in year 10 if you could buy it out in year 5 or 4. Most people have no idea where to start or how to really evaluate whole life insurance. That's why we've built the Vault. It's all of our best life insurance resources and educational tools all in one place, all for free. We have calculators, handbooks, crash course, deep dive videos on numbers. If you want to learn more, click the link in the description or tag comment below to unlock the Vault. All right, back to the video.
generally, yes. That is 99% accurate. Again, it depends on the chassis. So if you're a
Okay.
45-year-old and you're putting it on a 121 chassis with no PUA, that's not break even for a very long time, but because you're thinking differently about what your pension looks like on the back end.
I hear you. Okay.
But generally that's directionally, that is completely accurate, is that savvy clients who are young and healthy and staying healthy and have not consumed their human life value
Mhm.
can do that, can explore that.
Where does the rest of the money go? So 40% ish can go to life insurance. Where does the 50 to 60% go?
This is the hardest part about talking about cash balance plans now, about the DB system. And this is a very polarizing topic that we're
They
about to
can't go
swim
into
into.
equities?
They unequivocally can, and I think I
Oh, they
started that
can.
at the
Okay.
beginning of, like, you can do everything, and this was, I think, the 97% part was you have your cash, stocks, and bonds in a 401k. You can buy all of those in a 401a. However, this is super nuanced, and I haven't gotten this deep with anyone that I've spoken to, so kudos to you for asking this detailed of a question. The IRS's view of this, their posture is such that if we're giving you this large deduction, we're actually gonna mandate a rate of return. A 401, and this goes back to what is the difference between a defined benefit plan and a defined contribution plan? Let's just look at those words, the benefit and contribution. Contribution is a 401k plan. We let you put 23.5 in. You can do whatever the heck you want with that money. You can put it all in crypto and 3x to your example from earlier, right? In the DB space and the defined benefit plan and cash balance plans are called hybrid plans, but they lean more to the DB side. The IRS says, just like with the pension system, if you're going to get this huge deduction, you can't go shoot the moon. You can't go get a massive rate of return. So let's use our $100,000 example again. And remember, I said there's a 3 to 5 year commitment for a cash balance plan. I believe this year's required rate of return is 4.3, 4.4.
You say
So
required, meaning you can't make less than that, or that's the target that you need to shoot for?
target is a much better word. Yeah, you can make less in 1 year as long as it averages to that. So it averages to a 4.5, 5% rate of growth. You can have a down year, which you don't with life insurance, but you know what I mean.
Yeah,
If you buy equities, so let's use this example. Let's put numbers to it because I see
yeah.
sort of some confusion here. If you're doing $100,000 a year in a plan, right? After year one, that plan should be worth about 105,000. Then your next 100 comes in, so the plan should be worth about 205,000. Follow?
Yep.
If you put it in equities and the market goes down, which it's been known to do, people seem to forget about this in this spectacular bull run that we've had, right? And the plan, instead of being worth 205, is worth 160 because you had market risk in there. You need to true that plan up.
You need to put more money in.
Yeah, you got to get it to 205.
Interesting.
There's a corridor, so you don't have to do it right away. It's called
Yeah.
the IRS corridor approach, but basically you have to put in that additional $45,000. And depending on the TPA and the CPA, this is a point of contention in IRS literature, that's generally not deductible.
Really?
Now you got it. That facial
Yeah.
expression tells me, so what do you do with the other 60%? What we see as advisors who are not well versed in insurance and annuities design these plans with marketable securities. Totally allowed, totally doable.
It seems risky because it's either gonna do really well or not well, and I would assume if it did too well, you're also gonna get penalized. You can talk about that in a second.
Yeah.
But it's just sorry, I
No, go
killed
ahead.
your thought,
No,
but
you
I just,
didn't. You
like, I
didn't.
don't get in something like this, when the target's less than 5%, why would you want majority of your money in equities?
There you
Like,
go.
I just
So
don't see that
we have a
ending well.
firm view, firm both as an enterprise level, but strong view at our at the owner's asset that you design it with zero risk products. So let's use both of your examples. You do really, really well. That's a high class problem. Congratulations. Like you shouldn't
Yeah.
be stressed about that. But what have you in effect done? You've dropped next year's deduction.
Okay.
This is a tax play, right? So you're not going to get penalized for doing too
Okay.
well in a cash
So
balance
you're
plan,
just instead of being able to put 200,000, you're like, now you can only put 150.
which is real dollars because now that's $50,000 more of taxable income you're
Yeah.
showing on
But
your
it's not it's not the end of the world.
high class
Whereas
problem, as you
whereas
said. Yeah.
whereas having to call someone and say, "Hey, not only is the market down, but you're gonna have to cough up some money," that would be a conversation I would not wanna have.
Nor I. So we don't do it.
Yeah, okay.
So and again, this is a polarizing topic because I think a lot of the very good talented advisors out there who know about cash balance plans, they want that extra rate of return. And so obviously it's a spectrum. You can do 20% insurance, 40% annuities, and the rest in marketable securities, right? You can do bonds instead of equity. So there's ways to
Right.
do it, right? And not everyone qualifies for life insurance. We know that too. We typically design the remaining 60% with a very boring fixed income portfolio, and we don't manage money. We have, folks that we partner with, and our preference, though, is annuities,
Okay.
which gets really interesting because there are you said, are there specific products? I know you were asking that question about life insurance, but that same question applies to the world of annuities. There are fixed index annuities designed just for cash balance plans,
Okay.
so you are never out of compliance,
Okay.
and that's huge.
Now I got a question for you. So if in the first couple of years your cash value is not earning any rate of return, and let's say your fixed index annuities is hitting 5%, you still potentially are below your target requirement.
Slightly, slightly. And so what ends up happening is the following year, you have the option to put a little bit more in to true it up, which gives you that bigger deduction. But you don't have to do it every year. As I said, it's a corridor approach. But over a rolling sort of 5-year period, yeah, the plan has to be compliant. So in
Okay.
1 year, especially in that first year or two with life insurance, yeah, you're a little you're not caught up. You actually don't have to take action, but after a couple of years, if you are not, then yes, you're gonna have to pony up that money.
Okay. What is the target rate that you're shooting for with a FIA? That's a fixed index annuity.
Yeah, I think this year so each year on at the end of January, early February, the IRS comes out with guidance for plans, and I think this year they set it at 4.3.
Okay, what's the target that you're trying to get in a fixed index annuity?
So I think maybe I didn't explain it properly. A lot of the FIAs that we
Oh,
use,
they just give you
they
like
tie it to the IRS rate, so the
oh,
plan
okay.
is never out of balance,
Okay.
out of compliance.
Okay, so
So
they just this is a dirty word, but I can say it. They guarantee that rate.
absolutely, yeah,
Okay. So
because it's an annuity.
you're still down, meaning like the life insurance cash value. And again, I'm just talking out loud here, but you would obviously disclose that, and maybe instead, if 200 was like pushing the limits, maybe you go like, "Hey, we're gonna do 150," knowing that you'll actually have the option in the future to be able to put more money in.
Absolutely, because that was one of yes, great point, and that was one of our first points you and I discussed today is as you age and your income goes up, you can really torque this up.
Yeah.
Because you want a word you use a lot is architecture, right? And so the architecture of a cash balance plan should also incorporate the thinking that you want your deductions to go up as your wealth goes up.
Yeah.
This is built in. This is autocatalytic in that
Yeah.
sense. Because as your income and age go
Yeah.
up, the IRS is saying, "Oh, you can put more in. We get it."
Yeah. I'm gonna start using the word architecture. I don't know if I've ever used that
I
word.
thought you used
You
it.
gave
I've
me a lot
listened
of
to one or
credit.
two.
I'm
So,
gonna be more eloquent after this
oh
conversation. I feel
God.
like you're dogging on yourself, but you're using words that I'm gonna have to look up later. I'm like, this is amazing. Okay, so
So those are the design parts. I want
okay, so
to
you
swing
do
there.
life insurance and annuities, and then for other clients that want a portion, they can do equities, and you have another firm that does it compliantly. Do that.
We don't have any plans in place where equities are part of it. I
Okay.
actually think that's too risky.
Okay.
Um,
Maybe bonds could
Fixed
be
income, yeah.
fixed income could be
We haven't done that yet, but we'll send that out and partner with another
now, again,
organization.
I'm asking you questions you probably have never heard. Credit funds, I have some money headed towards credit funds, target anywhere from 8 to 11%.
Mhm.
nothing's guaranteed, but I feel good about the risk that I'm taking on. Could you do something like that, or are there limits onto what you can invest in, what you can't through a DB plan?
Yeah, there's generally limits that you could probably find a TPA that will hold that asset. The challenging part isn't finding a TPA, and let me just take a quick aside there. Most TPAs, most third-party administrators don't do cash balance plans because there are regs in place that an actuary must be employed by that TPA.
Okay, so
So it's
it's
a very
expensive.
cottage niche industry that life insurance and annuities inside of DB plans is to begin with. You can put credit funds. I actually know of a TPA or two that will do that. The most important element is the execution and compliance there. If we can get a fair value mark on that credit fund at a specific date, the plan will stay compliant. So I think I could execute on that challenge, and
Okay,
I want to try this now.
okay,
Now,
yeah,
now I'm excited to try it. It would be more so the plan has to be valued. It's called an AVDS every year,
okay,
now annual valuation data sheet. The plan has to be valued to see if it's under or
mhm,
overfunded, right, or inside that corridor. To our
mhm,
earlier dialogue, if we can get a proper mark at the right time of the calendar year,
mhm,
yeah, there's probably a way to solve that.
okay.
But let's finish this. Pull that string forward. If you're earning 11% on your credit fund, next year's deduction goes down.
Unless you have life insurance that for 40% of your portfolio,
That's slightly yeah, that's a
so
way to
tha
bridge it
that's
short
a
term,
way to kinda balance it
create
off.
a
The
ballast there.
problem is if the credit fund or the equities dip, now you have a life insurance that is designed for the first couple of years to
Right,
not have more than what you put in, and so now you could be, in I won't say a little trouble. I would probably say when you're designing these things, you're not trying to maximize every dollar because the idea of entrepreneurs,
yeah,
nothing's guaranteed, and I'm also just talking out loud. If you're doing this probably is not common on some young entrepreneur that's doing their first rodeo. If you're in your 40s, 50s, been successful, let's say you have a couple million off the table. So it's in one of those like, yeah, is this risky? Like I'm committing to a couple 3 to 5 years of 200,000 and let's say business is terrible. Nothing's taking away from my ability to just take $200,000 from my savings account, put
right.
it in.
If it's not a C corp, so any of the other entity types, if it's an S corp, right, you're gonna get your W-2 and your K-1. If it's an LLC, the origin of the money, it doesn't matter.
Okay.
And that's interesting. There are ways to freeze a plan for a year. In fact, the
Okay.
overwhelming majority of cash balance plans were frozen during COVID.
Okay.
So there's hardship clauses in there,
Yeah, that
right?
yeah,
So, because things happen, right?
right.
But if your revenue looks everyone has variable revenue. I don't know anybody business is the
Yeah.
exact same dollar every month, but it shouldn't look like an EKG machine. Okay, if it's looking like an EKG, you're probably not a fit for a
Okay.
cash balance plan, right?
Okay.
But if it's generally upward sloping with some variability around a tight mean, then there's a real opportunity for this deduction, this elegant set
Do
of
you do
solutions.
you know why the IRS is so strict on you having to commit to at least 3 years? Like, I'm just trying to put myself in the IRS point of view. They almost do they want to make this less attractive so not everyone and their mother-in-law is doing a DB plan?
Can't speak for the mindset of the IRS, so tough premise to reject, but they don't want you to do it for 1 year and then not for the next because this still falls under the pension sections. So 401(a) and
Okay,
412(e)s are the types of plans, and those are supposed to be long-term in nature.
okay,
So they're trying to asset liability match as well, right? There would be a lot of tax challenges if you could dump 300K in and then not and track it and the tracking therein. So I think it has to do with how I believe it was the 2006 Pension Protection Act that sort of gave it the guidance for a longer term to prevent people from superfunding and then canceling it.
okay, okay. Um, so you get higher deduction, you can buy life insurance and annuities. You have to commit to at least 3 years. 3 to 5 is the target. We talked about the exit plan. When you exit or buy out or distribute assets, are you doing the annuities as well, or are you just keeping the annuities in? And then how at when someone's age 59 and a half, is it act very similar to the 401(k) where you can now start taking money out, no penalties and all?
All of the above. The world is your oyster.
Okay,
So you want to get the insurance out. That's a major source of arbitrage. We've beat that
okay,
concept. What's so interesting is I think it was Mitt Romney and we were talking about Peter Thiel before when the podcast started. How do they get these massive
yeah.
seven-figure or
Roth IRAs. Yeah.
well, you just backed into how you do it, dude. Right? So if you can I think what 6,000, 7,000 or 8,000 is this year's IRA contribution. Well, this is, as I said, the exit plan of a 401A is the same as an IRA, and then it rolls into an IRA. So in our example of $200,000 a year at $40,000, 40% of life insurance, that's $120,000 a year that can go into the annuity. Okay, you do this for 5 years, right? You're talking about $600,000 right there. That would be the equivalent of, was that 52 years at $8,000 to get that, right?
Yep.
This is how you get a large retirement corpus. And then you can roll it to an IRA. And then what our savviest clients do is they then take that IRA and turn it into a self custody IRA, not a
Okay.
self directed. They're very different. Self directed means you're picking the investments. Self custody lets you do exactly what Peter Thiel did and Mitt Romney did, and these folks do, where you can then go buy real estate without leverage because of there's rules in the IRS code. You can go participate in alternatives. Credit funds become available to you. So, man, the arbitrage opportunities are super cool on the back end as well. So, yeah, that's I hope that
The
answers your
when you
question.
when you buy out an annuity, um, do you get any benefit, or you're just buying it at
No,
market value? So I'm trying to okay. So you okay, so then there's another thing, and this is there are tax strategies out there that if you had a big tax bill in 1 year, there are this is not tax advice, but there are creative ways that you can also lower your tax for 1 year. Um, so
lots of them.
lots of them, obviously, I have some people on the show that are talking about some unique strategies, and it just you got my mind going because this is a way to acquire life insurance. This is especially attractive, and then be able to buy it out, and you're saying, you can use the cash value loan against it, but there's nothing that says you can't get more efficient than a 40%. What if we could lower our taxes to 22%? And now it's even twice as better kinda deal.
Absolutely. Yeah. There's in the tax world, and neither of us are CPAs, so let's,
Yeah,
flash the no, not tax advice, right? There's hundreds of those kinds of strategies out there. There are 12 of them known as the dirty dozen, which the way those work are 100% of the people who participate in the dirty dozen get an IRS audit letter. From what I've read and heard anecdotally, less than 1/10 of 1% of those people actually get audited. But there's certain things that trigger that. Then there's a secondary set of solutions out there where you can get some pretty efficient tax savings in the years you're going to make a big move in or out of
mhm,
your IRA. So, yeah, I think that's the case. And, at the owner's asset, we interface with a lot of CPAs. And so if someone's
yep,
looking for an introduction to CPAs who
cool,
specialize in that area, we're happy to help.
cool.
But yeah, way out of our expertise to give tax advice.
Okay. What else am I missing? I feel like I have a pretty good grasp, and I wanna thank you. I hope the people watching and listening, this was as enlightening as it was for me. Like, this was awesome, but w where do you wanna go from here? I mean, what did I not ask, or what did we not cover that you think is important?
In the defined benefit world, I hope I lived up to your challenge of people haven't broken it down the right way. I hope I
Yeah,
have.
you
And so
yeah, this is
where do we wanna go from here?
phenomenal.
Look, you and I could talk for days about the role life insurance plays from a planning perspective. I come from the money management world. I've worked at a mutual fund, I've worked at a hedge fund, and then I became a CIO. And what I find most interesting about life insurance, this is cool. So what we've been talking about is how to buy life insurance wholesale, not retail. That's really, if you want to put a Englished up version of what a DB plan is, that's what it is. I could talk for forever with you about the other uses of how to structure
Yeah,
investments from life insurance. There's ways to look at it and say, can you buy the S&P and beat the S&P by using life insurance on a long enough horizon? Believe it or not, yeah. How crazy is that? Because you're putting in 100,000. We'll keep our example going. You're putting in 100,000. Well, in year 7, it's creating maybe 140,000 of cash value. Well, now you're putting in 140 into the S&Ps instead of 100, and you've just picked up 40%. That's approximately 32 months of compounding historical rate of return of the S&P. The way this creates more wealth is unbelievable. Intellectually, why I fell in love with life insurance wasn't actually DBs. I just found a cool opportunity to have an impact on our clients. And Bobby Samuelson, he writes the Life Product Review. did a podcast, and I forget who was on. He laid out probably the most cogent argument I've ever heard for life insurance as a bond proxy. Pretty much every advisor out there uses the same playbook. As you age, buy more bonds, buy less equities. I now get to reject that premise wholeheartedly and ethically because what is so interesting is if you have life insurance, you have probably the best bond proxy in the world.
Yeah.
I can't think of another bond portfolio that's going to give you 4.5% net of all taxes and fees with zero volatility. You're basically buying an indefinite zero coupon duration bond inside of life insurance where they're handling the tax headwind for you. What does that mean for your wealth creation? Well, we've all heard the stats. 97%, 98% of Buffett's wealth was created after 60, even as his rate of return has gone down because he never got off the equity curve. The biggest mistake financial advisors make is they're telling their clients to get off the equity curve right as it gets delicious, nutritious, low carb, high protein, right? Right when the equity curve is on your seventh double, your eighth double, your ninth double, they're working you off of that right as it's going logarithmic. If you add life insurance to a portfolio instead of bonds, you get to stay on the equity curve longer and create more wealth. That's actually why I fell in love with this asset.
So you actually, from a asset manager standpoint, you're looking at life insurance and you're saying this is a better bond alternative. Walk me through that because I have my own thoughts. I've actually just put together a one pager showing the difference between equities and life insurance and equities and bonds, some of the pros and cons. There's many strategies that open up that just are not suitable if someone doesn't have a death benefit. Like, if you have a death benefit, there's other strategies, SPIAs and all that now become more available, whereas, like, there's no way you would put a chunk of your money into a SPIA if that wasn't covered. I mean, you could, but it would just be you're creating potentially a more uncertainty with a very certain product. But when you have a permanent death benefit, it's a permission slip that helps you unlock other assets. So talk to me in your own words, bonds versus life insurance. If someone is just like, "Ro, I want to," like, I'm skeptical because I, I'm telling you, we're on the same wavelength. There's there's so many people that just don't get this, and I actually feel like the market for this conversation is 100 times bigger than the infinite banking market.
I agree with all of that. You use language just now. You said covered twice and the permission slip. You've read the fifth option, it sounds like that.
Yes,
Yes, one
yeah.
of my all-time favorite books.
So plug, Walter is gonna be in the studio next week, and, I've had him on the show multiple times, and we're doing some really fun things. We're
We're gonna
we're
throw it out because I read a book a week generally,
we're doing
and
some
so
fun things, so stay tuned. That's why you should be subscribed, by the way. If you're not subscribed to this channel, you're killing me.
so the
Alright,
covered asset strategy is fascinating because, yeah, you basically can take a Monte Carlo simulation from 99 to 100%. It's very perverse to say that, right? Because it's turning math in on its head. And I joke about not mathematical ability because I used to build algorithms at the hedge fund I worked at. And so what I find so interesting about your covered part, and then we'll move to the bond proxy in a second, is that couldn't be more correct because basically you're taking a fixed stream of income in, provided it is at the same size of your premium, and you're turning, as you know, cash value gets more efficient as you get older. You're creating a new phrase. Let's make one up: infinite wealth, right? From this
not
from
compliant.
right, yeah, from
The
this
compliance officer is dying
right,
inside.
dying, right.
Okay.
But so that I do find interesting, and I think
Yeah.
that is a strategy that not enough people explore. Now let's talk about that because financial advisors are paid on AUM. And so there is a disincentive to explore a guaranteed outcome or a non-forfeiture outcome. You're right. The word guaranteed is polarizing, right? Okay, to the bond proxy argument. Let's start with, to me, the most lockdown element of it. If you're a very sophisticated bond investor and you are able to access mezzanine debt, credit debt, and all that stuff, and you're getting 8, 9, 10, 11%, there's still some tax headwinds there.
Interesting.
Okay.
So there's bond investors that would. I mean, how much risk are you taking if you're going for 7 to 9% in a bond?
A lot more than you realize.
Okay.
A lot of these there's some pre-collateralization in those bond portfolios. Now I get to put on my CIO hat. So this is fun because I haven't had a market talk in a while now that I'm just exclusively focused on working with small business owners for DB plans. But yeah, look, you have a lot of illiquidity when you tie it up into a credit fund,
Okay.
typically 10 to 12 years, right? You have a lot of uncertainty. There's a tax headwind there as well. You have counterparty risk. You have a lot of other issues. And you can't go 100% in that, right? You'd have to have some municipal, some corporate, some treasuries. So your rate of return will collapse to the mid sixes.
Okay.
Okay, but you strip out taxes and volatility, you're trending to 4.5 to 5.
Mhm.
On par with life insurance, maybe life insurance is a little bit behind that. Here's where life insurance wins. This is a bold statement, film this, I'm looking at the camera for this, okay? I will close my business tomorrow. If somebody can show me a strategy that will pay me what my bond portfolio would have grown to if I die before natural age, that doesn't exist. That's the death benefit.
And if you can
Okay.
challenge him, let's come on the show. Let's have a debate. I would love
Right?
that.
But I don't know of a bond portfolio. If you put $1 million into bonds and you also acquire $1 million of DB, no bond portfolio is going to pay you what it would have grown to in 30 years if you pass. So there's always the arbitrage of the DB, of the death
Yeah.
benefit in there. So that's to me is the most interesting argument of the bond proxy. But now to your second point, is this conversation is 100 times bigger than the infinite banking conversation. I'm going to say it again. If you can stay on the equity curve for longer, you make more wealth. Or stay on the real estate curve. It's more important for real estate because you're illiquid forever. And if you're going to manufacture a terminal cash flow to cover either the debt you have on your real estate or the estate taxes,
Yeah.
you can be a net acquirer of real estate in your 80s.
Mhm.
That's it. That's the ball game. That's why it's so important. The life insurance will actually enhance the rate of return, if for no other reason than you don't have to alter your asset allocation. Back down every 5 to 7 years. The playbook's the same. Let's walk you back 500 basis points of bonds.
Yeah,
90,
and you're
10,
actually
80,
just it
20,
just
70.
gets better every single year. And as we're wrapping up, landing the plane when it comes to DB plan, talk about the estate plan aspect. We're just focusing on the cash value, but the death benefit you mentioned doesn't even get calculated in the buyout,
No.
which is crazy to me.
Don't get me going to estate planning because I'm a freak.
Yeah, yeah, it's just crazy to me because it's such a life insurance is so much more valuable than the cash value. But the IRS is essentially saying we're gonna give you the death benefit for free. I mean, that's kind of what I'm reading
I
into
can go
it.
over all that. So
And
fire
so,
away.
yeah, so talk about if someone I'm thinking of this through the lens of cash value and cash supplement, but this is a straight up estate planning dream to be able to
Estate planning dream and
yeah,
you
talk
gotta
to
edit this
yeah.
out because I'm gonna go like
Okay,
off script for a second. But like
what do you
when
mean
I was
edit this out?
no, no, what I'm about to say to
Okay,
you. Like
okay,
I don't
okay,
even
okay.
like with humility. When I was the CIO, I had to personally design and build the estate plan for 4 billionaires.
Wow.
My level of expertise here dwarfs
Why can't
what
you
I
say that on the
know
camera?
because the bank when I left, it was
Oh, okay,
they
okay,
were so. That's actually
okay.
why I took I left the bank actually to start my own hedge fund, and I started 6 months before COVID. My dream was always to run my own hedge fund.
Interesting.
I couldn't spell life insurance. I got licensed 28 months ago. I've only been licensed for about 28 months or 30 months.
Dude, yeah, I love it. Okay,
Yeah.
so but you're let's go back to estate planning. I love this. So you're a freak when it comes to estate planning.
No, that's a strong word, but I have a lot of experience having been in wealth management for a while, and I think one of the most or misunderstood aspects of life insurance role in estate planning is a word you used, is a permission slip. So let's picture a T, okay? Should I keep going or are
Yeah,
we
keep
gonna
keep
pivot?
going.
I
Yeah,
won't lose
thank
my
you.
train of thought.
Yeah.
So let's picture a T, okay? Up and down is time,
Yes.
and left and right is gonna be in your estate and out of your estate. Cool? Okay, so the goal for many people is to pass money down across generations, the time element, right? To pass it down with as little tax friction as possible. Okay. When you move a dollar out of your name into an irrevocable trust, right? It's now out of your estate. It won't get taxed, which is roughly between 40 and 50%. And quick aside, anyone who's really curious about estate planning, Google what happened to the Boston Celtics. The family that owned the Boston Celtics were forced sellers of the Boston Celtics to the tune of, I think, $2.3 billion because they didn't have a proper estate plan. They were so illiquid, they were all in on the franchise. They were forced sellers to pay their estate taxes.
Whoa.
Unbelievable, right? To have one of the most storied franchises in any sport in history. So this is super important. When you move a dollar from your name into an irrevocable trust, it's out of your estate. But interestingly enough, it doesn't get a step up in cost basis. Okay, enter life insurance. Permission slip. Let's go back to that word. We're going to borrow from the Fifth Element guys and put it into estate planning world because I actually thought they were bridging something neat there intellectually. For many of my clients, we recommend keeping as much money in your name as possible, creating a taxable estate, but having enough life insurance to pay the bill to Uncle Sam. Because what happens is, so let's say somebody, I don't want to use you because you're right here, but Mike Jones is worth $50 million. 50% 40% it scales up to 50 of all the money above 30 million. So 15 million per person, married, 30 million. So $20 million is going to be subject to a 50% estate tax. They're going to have to write a check for $10 million to Uncle Sam. Okay. 99 out of 100 advisors are going to move that 20 million to an irrevocable trust. Valid, do it. I'm not here to say what works isn't appropriate. I'm just saying there's other solutions on the board. If you were to then go acquire $10 million of life insurance instead, you can keep all 50 in your name. The couple passes, the IRS says, "You owe me 10. Your silent partner, you owe 10." Well, the death benefit just created the 10 million. So you have the insurance company pay the IRS. I mean, it comes to you quickly, and then it pays the IRS. But here's the magic: if that 50 million or that 20 in this case was in the irrevocable trust, it wouldn't get a step up in cost basis. You're handing a tax problem to the next generation. If it stays in your estate, it all comes up. So now the kids get 50 million.
Oh, man.
The kids get 50
Yeah.
million as if they bought it that day.
Yes.
So you're not
Because if they inherited it in through the trust, they're gonna have to pay tax on that at ordinary income.
I mean, you can structure a trust, and I worked at Wilmington Trust for a few years, wonderful company. You can structure a trust to be generation skipping and push some of the taxes off, but yeah, eventually that tax bill.
That's
So
interesting. Yeah, that's
so the role of and so link it back to DBs from the first part of our dialogue. If you're a business owner or a 1090, oh, that's the area we didn't cover. Who can qualify
Oh,
for a
yeah, yeah, yeah. Let's
401a?
yeah, let's talk about that. Let's talk about who can qualify for a 401a.
And 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 I hate to talk about some of my stuff, but, like, we put out a video on this, so
Yeah.
if you
Oh,
don't
no, we'll
mind,
link.
I can add it to
Oh,
the
yeah, yeah,
show
link.
notes, but I never want to impose.
No, 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 we'll link. You have a YouTube channel?
The way soon.
Okay, okay. Yeah, we'll link it.
The way I explain it to folks is there's actually 2 retirement systems in the US, and I call it the secondary retirement system. There's the 401k system, and then there's the 401a system. If you have active K-1 income, you can do a 401a. If you have 1099 income, you can do a 401a, right? But if you have traditional W-2 income, you actually cannot do this. You cannot put a D. If you are a rank and file employee, let's say I work at Fortune 100 company, name it to remain nameless, and I am a upper middle manager making good enough money where I need these deductions and I need this planning, I can't do this. W-2 income does not qualify. Now there's 45% of your audience is probably saying, "I have an S corp. Does that count?" Yes. W-2 income from your own S corp does
Oh,
count.
interesting. Okay.
Okay, so it
Okay.
has to be self-employed income. So W-2 from your own S corp, 1099 and active K-1 income, you can participate in a DB plan,
Okay.
and you can do this. So yeah, you can really offset your income. So side hustle generates 1099. You can do this. If you're a professor at a university and you're earning
What's the
W-2
minimum
income,
you can put into a DB plan?
there really isn't 20, 30 grand. You can start very
You could start
small.
small. How does it scale, though?
Thank you. Great question. The TPA fees are typically between $1,500 and $3,000 a year or more. So, like, if you're doing 30,000, you're paying 1,500 for the fees, your ROI is sort of,
Yeah, I see.
but look, can you still get 40% insurance on 30K? Is it still worth it? Probably, because there's still some tax arb.
Yeah, I see, but it really gets good. What would you say your minimums would be? 50 to 100K?
Yeah, we typically do that, and it's an employer sponsored plan, and so you do have to include all of your employees in the plan.
Okay.
And so this is a reason some people don't do it, which is interesting enough. You can design a cash balance plan to heavily favor the business owner. Instead of like in a 401k plan, it's 3% for everybody or 6% for everybody. You are allowed to actually use certain sections of the tax code and cross testing between a 401k and a 401a to benefit key employees or the business owner
Well, I
themselves.
just thought you said that W-2 income doesn't you
Yeah.
can't
So
do it.
as a W 2 employee of a business, so let's say you own a company
Yep.
and I'm your employee and you start a DB plan. Caleb starts a DB plan. I will have to participate in it, but I don't get the deduction. You do. You're the business owner. So the business owner gets 100% of the deduction, and anywhere from 70 to 92% of the capital can go in their name.
Okay.
But I, as your employee, can't say I'm overburdened with taxes. I'm going to go start my own 401a. I can't do that.
Okay, so if I have a team of 15 plus, it's maybe not as attractive?
I think it's very attractive because what you can do is one, I think good managers and good leaders. Now we're moving into sort of
Okay.
organizational behavior, really cool social psychology now. Um, use a cash balance plan as a form of long-term
Incentive.
incentive to stay at golden handcuffs, right? Because there's a 3-year cliff vesting or a 6-year graduated vest inside of a DB plan. And so if you want to retain key employees, you can put them in the plan and actually pay them a little more in the plan. So you're giving them a benefit. And they're like, if they leave in month 35, they get goose egg.
You don't have to get that's interesting. You don't have to pay self-employment tax on that,
Yeah, your employee
and
doesn't.
you get a deduction.
Caleb, as the business owner, gets the deduction.
Okay.
The
And then they're putting their money in insurance as well or whatever?
You're putting money in for them. You're getting the deduction. It's the business's money that's putting it
How
in.
much money do I like, again, I love you, team. I'm just asking questions here. How much would I have to put in versus like, what talk to me about could it heavily favor the business owner? Or how do we
Yes,
talk to me about
it
this?
can be generally what you want. It can and 99 out of 100 plans heavily favor the business owner and the key employees.
Okay,
But you can also design it to be completely egalitarian and have all employees participate equally, but we typically don't see that, but
okay.
it can be done as a tool of social
Could I start a side hustle and have my DB plan come from that? Or
unequivocally, yes, and that's probably the best use case
so,
for people.
just hypothetically speaking, I feel like my language is getting more eloquent just having you in my presence. Let's say my entity is doing well and I have a consulting company that I spin up, and that consulting company, you know, we're able to shift over a couple $100,000 to the consulting company. Obviously, it's done properly, blah, blah, blah. T's are crossed, I's are
Yeah.
dotted. The IRS is taking notes right now, I know. um, that I could do a DB plan through that.
Unequivocally, yes. And so, yes, and you would be able to deduct the overwhelming majority of that income coming into that entity to do that. So that's that side hustle that we
And
talked
you
about.
wouldn't necessarily have to include.
No, because that's that entity
Okay.
is a separate
So
entity.
there's ways, but I'm also with you, like, there are ways that you can use this. I don't want people to jump all over me and be like, "Oh, you're trying to screw your employees." I'm just asking questions. It helps for
So,
me to understand.
so
So now let's say I'm like, "Hey guys, I wanna create a golden handcuffs," and I have some people on our team that I'm like, "I would love to lock up."
mhm.
They so are they getting life insurance on them? I know I'm funding it, but, like, if they leave within 3 years, do I just keep the money?
Yeah.
You really?
So this you brought up 4 points. You brought up 4 very interesting points in that arc of that case. And so I'm just trying to like organize it in my head here. The first thing is your team should be excited you're having this dialogue because even if they're in the plan but get in de minimisly, it's still 100% more money in their name than they would have had anyways. Okay.
Right,
So if 90% is in you and you had 10 other employees and 1% is each in their name, that's still 1% more capital in their name
right.
that they didn't have. So any move in the DB space when you're including your employees is inherently altruistic and is inherently egalitarian. Period. So your employees should love it because it's another benefit they're getting, right? You
Yep,
are accruing 100% of the deduction. So you should actually smile at your team and not worry that they're because it's more this idea
yep,
of I'm doing this for the business and everyone is coming along with me.
or
So, right?
yeah.
That's wonderful. So I don't want you to feel angst about your team watching this. If anything, that's exactly
No, that was
right.
a joke. We have an
Yeah.
amazing team, yeah.
You talk very positively about your team when they're not around, which tells me it's a high functioning
Yeah,
organization, right? Um, and again, I was a former executive, so the measure of an executive is how people talk about them when they're not in the room,
mm,
right? So the second point I think you made was, do they all have to have life insurance? Uh, it needs to. There are statutes here. That needs to be offered to everybody, but people can opt out. But you just stumbled into my favorite use case of life insurance in a DB plan. If you have 5 or more participants in the DB plan, you can get guaranteed issue.
no way. No way. Are you
I
serious?
know, we're, like, walking away from the mic because 'cause we're so excited. We're
So
screaming into the
attorney
microphone.
groups and doctors and all that are all, like, partners, they could get guaranteed life insurance issue,
You could
and
you
you can structure them competitively?
you have a lot more handcuffs and
Okay.
not in the fun recreational
So
way.
if everyone's healthy, you may decide to not opt out of that and get underwritten, but if there's 1 or 2 people that were like, "I'm not sure they're gonna get favorable deals," you could go the
Yeah,
guaranteed issue route.
yeah.
Interesting. Wow.
Super cool. So that was your next point about, do they all have to have it? And then I think your third point was if they leave before their vesting and they do, if they leave before they vest and they have life insurance, and if they leave before they vest and they don't have life insurance, right? Both collapse to the same answer, but they have life insurance, they can distribute out to themselves.
Mhm.
They can forfeit it, and the cash value goes back to the entity, back to your company,
Mm.
and you can just use it for next year's DB. You still
Okay.
get the deduction, right?
Yep.
It still get the deduction for it. And then if they don't have life insurance, then yeah, their portion of the DB plan, their portion of the annuity or the fixed income portfolio or whatever that they have just stays in the plan and can be
And
used.
you can if you have a couple key team members, you can incentivize them greater than maybe someone who just got hired a year ago.
Okay, you stumbled into 2 new points there. 12 months of service, then you can participate. So if you
Okay.
hired someone next week and you're not sure they're going to work out, they're gone. Huge, huge benefit that the people don't think about. If you hire someone on day one and they put a bunch in their 401k and then they leave before the 1 year, they're taking that with them, including your match. You hire someone in a DB plan and you put them in the DB plan and they leave within a year, they don't get it. So it's actually beneficial.
Interesting. Okay.
Yeah. So that I think
Very
was your
interesting.
first point about new employees. Um, and then to incentivize was your second point. Yeah, there's minimums you have to put in each employee's name based on job classification and their earnings, et cetera. You as the business owner are allowed to then say, you can add more to that.
Yeah.
Absolutely. You can do that.
What else do we I wanna land the plane with DB plans. Anything else that's like
You're reaching the end of my brain.
okay.
So I think a lot of people will think, okay, how do I qualify? Active K-1, 1099, and W-2 from your own S corp.
And really the target should be 50 at a minimum, but really the target should be 100,000 plus.
Yeah, look, the more the better, because every dollar that you're putting in, you're not directing to Uncle Sam, you're directing to yourself, right? So that's the first, I think, to land the plane with DB plans. Um, I think the second element is there's multiple sources of arbitrage if you include life insurance, and that's really super interesting, right? We specialize in buying life insurance with wholesale pricing, not retail pricing, because of the size of the tax
Yep.
deduction, right? And then the last part about it is you actually understand what it is. I want to go back to the very first dialogue we had of a 401k and a 401a. They're in the same section as the tax code. There's a couple nuances that are different,
Mhm.
but
Yeah.
if you like your 401k, you're probably going to love your 401a.
Oh, for sure, especially if you understand life
Yeah,
insurance. It's
right.
really interesting. I want to thank you for taking the time to break this down. Um, I really feel like I have a deeper understanding of this, and I understand why for some people that this is an absolute no-brainer. And I think if you're a CPA watching this or listening to this, something that you should really lean into. We'll have anything that you want to give me. We'll put below. We'll put your playbook
Yeah,
below. I'm super happy to know that you're making videos. I think you're gonna crush on
that'll
YouTube.
be
So
fun.
we'll put whatever that. And then if you're someone that wants to learn more, Ro, thank you, and I know that you are willing to help any of our audience,
Yeah.
up their game, so
Thank you. Thanks for having me. It means a lot. Thank you.
If you're an advisor, life insurance agent, or someone who just loves the life insurance space, we have a must-attend event for you. It's our 5th annual Life Insurance Summit, June 15th through the 17th, right here in Nashville, Tennessee. Not only are we going to have the biggest names in the life insurance space, but this is also an incredible opportunity for you to meet and connect with like-minded individuals and be a part of our ever-growing community. Learn more and get your tickets before they sell out in the link in the description or pinned comment. Can't wait to see you there.